Yo my people, welcome back to the third episode of Project 30. Now in today's video, I'm going to be going over something called liquidity. You guys might have heard of this before, and this is probably one of the most important lessons that you guys are going to need to pay attention to. Or I can't lie, they're all important, but this one here is what fuels the market. It's what makes the market move. Now we understand the basics about market structure. We understand how a breaker structure just tells you where market is most likely to go next. Liquidity gives you a target and it helps you understand where the market is drawn towards. Now if you guys haven't seen my face before and you're thinking who that, well not my face, but if you guys haven't seen me before and you're wondering who the hell is this guy with a mask and trying to speak to me about trading, my name is OneFX. I'm a content creator and I'm a day trader, and I'm dropping a free project to help you guys get into trading. Make sure you check out episode 1. So without further ado, let's get right into this episode. So you guys should know the drill by now. Get your pen and paper and write this at the top of your piece of paper. This is the title, liquidity. Now liquidity is where resting orders lie in the markets, or people's stop losses, or people's entries to their trades. Does that make sense? Now I'm pretty sure you guys know what a stop loss is. Basically when it reaches this, when it hits your stop loss, you get taken out of the trade basically. Now that we know what liquidity is, we have to understand where is it in the market. There is liquidity on swing highs and swing lows. So if we zoom in, we can see that this swing high here, we have liquidity resting here. This high here, there's liquidity resting here. Now I want you guys to make a note of this. The strongest points of liquidity are equal highs and equal lows. As you guys can see here, these are relative equal highs. So there's a lot of liquidity here. Does that make sense? Now going back to the first episode, what did I tell you guys? To never ever trade accumulation. Why? Because this is the market generating liquidity. Another thing as well, don't ever have your stop losses on equal lows. You guys can see here, these are relatively equal lows in the market. If I was to try just buy here and put my stop loss on these lows, why shouldn't I have it there? It's because the market, this is a clean draw for the market. The market wants to take it. It knows that everyone's stop losses are resting there. The money is on the line there. Does that make sense? So what is the market going to do? Of course, it's going to go and take it out. So same rule to never ever trade accumulation, because you'll just get chopped up in this entire range. Never ever trade when your stop loss is on equal highs or equal lows. One set of sellers have their stop losses on that high, and another set of sellers have their stop losses on this high. Think of it as like kind of double the liquidity, double the money. Now make another note of this. The market is always hunting liquidity. So as you guys can see here, we very clearly have a market structure shift towards the downside. So this is indicating to us that price is moving towards the downside. Now if we just zoom out and go to the left, we can see that cool. There is liquidity resting here, and there is also liquidity resting on this swing low. These are targets. This is where the market is targeting. Now I want you guys to understand what actually is liquidity. Yes, it's people's stop losses, but I want you guys to understand why is it on swing highs and swing lows. Let's just give an example here. Let's just say I was in a buy because there was a breaker structure towards the upside here. Let's just say I was to wait for a retracement to get in. I was to buy and I was to put my stop loss on this low. This blue thing is my stop loss. My take profit was to be wherever on another high. Why would I put my stop loss on a swing low? Why wouldn't I just put it like in the middle of the low, a bit below, covering it, etc.? Why would I put it on the swing low? Pause the video and think about it. If you can figure it out, then I can't lie, fair play, you're pretty smart, because 9 out of 10 times when I ask people this question, they don't know the answer. Now it's very simple. It's because we know if price was to break below the swing low, what is it? It's a market structure shift. It's a breaker structure towards the downside. And what do we know that breaker structures tell us about the market? It tells us that the market most likely wants to continue going in that direction. Now think of it like this. If I was to buy this, I don't know, this shoe for $10 and my stop loss was worth $5, I would rather lose $5 in this trade than let it go down to 0 and lose the whole $10. Does that make sense? So this is why we have our stop losses on swing highs and swing lows, because if price was to go to that point and go past it, then of course it's invalidated the trade setup for us. It's given a breaker structure and it's telling us that your trade idea is invalid. Your idea that the market wants to go up is wrong, and instead the market actually wants to go towards the downside. Does that make sense? So linking it back to this, as you guys can see, when we have a market structure shift, this is now telling us that the market wants to go lower. Where do we want to go though? This is another thing we have to ask ourselves. To these points of liquidity, this is where a lot of people had their stop losses. You guys can see that anyone that was buying here would leave their stop losses here, and again, more buyers that were buying around this area here, they would have their stop losses there and they would be targeting wherever. It doesn't matter. However, we know that there is money on the line here. This is people's stop losses. Now notice how the market is always taking liquidity. You guys can see here, we have liquidity resting here, relative equal lows. We have one set of buyers with their stop losses there, another set of buyers with their stop losses there, another set with their stop losses there. Retail traders are looking at this as a level of support because they're thinking that this level cannot be broken past. However, there are also traders that trade breakouts, something called breakouts. So essentially, this is a level of support. You guys might have heard support and resistance. I do not trade it. I don't condone trading it. I mean, if it works for you, it works for you. But if it did work for you, you wouldn't be on this playlist watching this video right now. But nevertheless, people are looking at this as a level of support. Now, there's a saying in trading that when a level of support gets broken past, it turns into resistance. So what people auto trade is, once this level of support gets broken past, when it gives a retest, they will try to sell. These are called breakout traders because we've broken out of this level of support. Now, the market knows that and it understands it. So what does it do? It takes out this level, it gives a little break. Buyers are now taken out of the markets. Why? Because their stop losses have been triggered. Sellers are now entering the markets because they think that this level of support has been broken past. And if this level of support gets broken past, it means that we're most likely going to go lower. So sellers enter the market and they get taken out as well. This is why I don't trade support and resistance. It's not really effective. It's not accurate whatsoever. But as you guys can see just from that example, the market is always taking liquidity. Now there is something called a liquidity sweep, which is basically what I've just showed you guys right now. I want to ask you guys a question. Is this a breaker structure? You guys should know the answer to this question. This is not a breaker structure. Why? Because the candle body failed to close below this swing low. So this is indicating to me that it's not a breaker structure, and instead it's indicating to me that it's a liquidity sweep. You guys make a note of that. A liquidity sweep is when we take liquidity. Liquidity rests on swing highs and swing lows. As you guys can see, people have their stop losses here. When we go past this point, we're just triggering the stop losses. Now remember, what did I say to you? The market is always chasing what? Liquidity. So you guys can see that there's more liquidity resting at the highs. You guys can see these are equal highs. We have one set of high here, two sets of highs here, another high here. Sellers are looking at this as a level of resistance. So whenever it taps back into this, they're selling. You guys can see this entire area at the top. It's price to struggle to break past it once, twice, 3 times, 4 times, 5 times, 6 times, 7 times. So we know that there's a lot of liquidity here. So what is the market going to do? It's going to take that. Why? Because we've taken out the buyers. We're now going to take out the sellers. And as you guys can see, we tap back into it. We give another reaction, inviting them sellers into the market. And just like that, they all get taken out. You guys can see this whole entire level gets breached. This is called the liquidity sweep. Once we've taken liquidity, once we've went above these swing highs and swing lows, these are liquidity sweeps. Now I want to combine this with breaker structures. What do liquidity sweeps tell us? This is telling us that price is failing to go lower. A liquidity sweep is confirmed with a breaker structure. Make a note of that. I'm going to repeat that again. A liquidity sweep is first of all indicating to us that price it can't go any lower. It doesn't want to go any lower. The intent to come to this point in the market was purely to take out these traders that have their stop losses resting on these lows. So now that it's taken these out, if it's failing to go lower, it's obviously going to reverse and go take out people that have their stop losses on the highs. Now if we were here in price, we cannot confirm that this is a liquidity sweep and that we now want to reverse and go towards this high without a market structure shift. So this is where we have to wait. We then get a market structure shift. This is confirming to us that price wants to go and take out the highs. What does price do? It retraces buyers into the market, and just like that, I'll play it on fast mode. You guys can see that it takes the highs any second now. You see how it's kind of like a game of ping pong. The market is always chasing liquidity. It's going from liquidity point to liquidity point. I'm going to go over a few more examples with you guys before we get moving. So as you guys can see, these two relative equal lows down here in the markets, what happened to them? Buyers had their stop losses here and here. What did price do? It dipped below this point. Breakout traders entered the market, and what also happened, these buyers, their stop losses got triggered and they lost their money. Now how do we confirm this is a liquidity sweep? We need a market structure shift. So as you guys can see here, this swing high here gets broken above. This isn't really the cleanest market structure shifts I've seen, but nevertheless, it's still a market structure shift. What does this market structure shift now tell us about price? Price wants to reverse. So what happens? Price retraces back into the range. Buyers enter the market. Quick question, would this be a market structure shift or a breaker structure? This one here. It would be a breaker structure. Why? Because the market has shifted structure. If we continue, this is a break of structure. We can't shift structure again towards the upside. Does that make sense? So now that we've gotten a liquidity sweep confirmed with a market structure shift, confirmed with another breaker structure, we should have full confidence that price wants to go towards the upside. It wants to continue going in that direction. Where is it going to go? It's going to go target liquidity. Remember, it's like a game of ping pong. Once we take out the sellers, we take out the buyers. Once we take out the buyers, we take out the sellers. Where are the sellers' stop losses? Sellers have their stop losses resting on swing highs. Buyers have their stop losses resting on swing lows. And if we zoom out to the left, what can we see? There are relative equal highs resting here. This is a point of liquidity where the market is magnetized towards. Why? Because it's like double the liquidity. Does that make sense? So once we take this high, this would be known as a liquidity sweep. I want you guys to understand another thing. Whenever we take liquidity in the market, it fuels a move to go into the opposite direction. Does that make sense? Liquidity acts as fuel in the market. When price doesn't have liquidity, when the market doesn't have liquidity, it starts to create it. It generates liquidity. This is also known as accumulation or consolidation. Now, I told you guys as well, the market will never just completely move sideways and generate equal highs and equal lows and show to you like, yo, I'm accumulating, don't trade me. It will fake you out a little bit. It might even move in a specific direction, but however, it will be very slow and inefficient price action. Take for example this area here. This is very slow price action and is clearly inviting sellers into the market. We have a very clear trend line towards the downside. So trend line traders are looking at this as, yo, I want to get into the market because we're selling off, and this creates a lot of liquidity resting at all of these swing highs above. You guys can see there's a lot of swing highs here. So what is the market going to do? Of course, it's going to come up and it's going to pinch out all of these sellers. What is price now going to do? It's now going to go and reverse in the opposite direction. Does that make sense? Because we've taken out the sellers, we have no reason to continue going up. We're now going to go target the buyers. Buyers stop losses are resting on swing lows. You guys can see here, this swing low is the target. How would we know that? We get this market structure shift here. You guys can see price closes with a body below this low. So once again, we have this liquidity sweep. Price has failed to close above this swing high. You guys can see it's put in a wick. If it was a body, then this would be a breaker structure. However, it's a wick. We get a market structure shift confirming to us that the market structure has shifted to being bearish. It was originally bullish. You guys can see we had a high, a low, higher high, higher low, higher high, higher low, higher high. However, we established a lower low. This is now confirmed to us that the target is now lows and we don't want to go any higher and maybe take out this point of liquidity here. Does that make sense? So I'm hoping this all makes sense for you guys. I'm hoping you guys understand what liquidity is. It's just simply people stop losses resting on the line. It's resting orders in the market. The market wants to take that because if it takes you out and you lose, who's winning? Other people in the market essentially. And I want you guys to understand another thing. Before any big expansion move, so you guys can see here there's clearly a big expansion towards the downside. What has to happen? Price has to take liquidity. You guys can see price takes liquidity here. It takes this swing high. What do we then have? We kind of get a market structure shift below this swing low here. This is now confirmed to us that price wants to reverse, and as you guys can see, price reverses. If we zoom in again, you guys can see we have a swing high here, and what does price do? It pinches it. You guys can see it just about takes it out. I don't know if you guys can see that, but it does take it. Once we've taken out these sellers, what are we now going to do? We're going to go take out the buyers. This liquidity sweep has now fueled a reaction for us to reverse. You guys can see we get the market structure shift here. Price retraces, people enter sells, and this now dumps and it takes out all of these buyers that have their stop losses resting on this swing low, on this swing low, and on this swing low. All of these buyers here, they all get taken out. Also, if you guys want more details on specific liquidity sweeps I'm looking for and my actual strategy and how to actually trade it, and if you're actually trying to take your trading seriously into the next step, make sure you check out the link in the description. As usual, I want you guys to go over your notes, go over anything you might have learned in this video, and go on charts and apply it. Remember, repetition is the mother of all skill. I want you guys to go on your charts and just mess around with it. Just play around with it. You guys can actually see here, we have a liquidity sweep. We take out all of these stop losses here. This whole level of support where buyers were looking at this to potentially buy, they get taken out. Now where are we going to go target? We're going to go target the sellers. You guys can see we have highs here, more highs here. These are relatively equal highs. Again, more liquidity resting at the highs. These are very clean draws for the market to take, and you guys can see we have a liquidity sweep. We follow through to confirm that it's a liquidity sweep with a market structure shift, and price reverses and it just flies off and takes out all of these sort of sellers at the top. So yeah, like I said, just go back in your charts and play around with it, mess around with it, man. Have a bit of practice, yeah, and before you know it, you'll be able to identify these liquidity sweeps. I'll literally close my eyes, wallah, I'm not looking, and I'll just find a random point in time. And I can see, cool, we have a liquidity sweep at the top here. You guys can see this high here gets pinched. I can see that. Why? Because it's market experience. I've trained my eyes to see these things. You guys, you're going to hop on charts and you're going to try to see these things and you might struggle, which is okay. You guys need to be putting in the same amount of hours. And one more thing I just want to go over. How do you know the difference between a liquidity sweep and a breaker structure? To identify a valid breaker structure, what do we need? We need a candle body closure above or below a swing high or swing low. This is usually your first indication whether it's a liquidity sweep or breaker structure. As you guys can see here, these relatively equal lows down here, what happens? Price fails to close below this point. So this is my first indication that it's a liquidity sweep. The second thing is you'll get a breaker structure followed through with every liquidity sweep. Does that make sense? And that's literally the most easiest way to differentiate the difference between a liquidity sweep and a breaker structure. But anyways, I'm hoping you guys learned something new from this video. Make sure you guys drop a follow, likes, comment, subscribe, all of that good stuff. And I'm going to see you guys in the next episode. Take care, my people.